One of the key assumptions in the federal budget is just how quickly inflation will fall. Treasury says it will be back to 2.75% within 18 months. But some say that's way too optimistic. So let's go to S&P Global's Director of Sovereign and International Ratings, Anthony Walker, who joins me now. Anthony, many thanks for your time. You say, for example, that you think it's going to take a lot longer to get inflation out of the Australian economy.
That's correct, Ross. We do think it will take a couple of years to get the inflation back to the RBA target of below 3%. We see a lot of pent-up demand still. We know discretionary spending is falling. We are seeing service spending rising. But these supply-side issues we've had globally are not unwinding instantly. So you can take some of the demand out of the system, but the supply-side challenges are going to persist for a number of years.
So what are the consequences for the budget and indeed for the government's debt and deficit if they do not get this inflation out of the system as quickly as might be expected?
Well, in the short term, if the economy stays going healthy, it's actually positive for the government. What we will see is nominal GDP rising. We will see wages and taxes rising. So it's actually good for the budget. And we saw that last night. Where it becomes a problem that in a few years' time, if they haven't got a control of inflation, as the RBA keeps mentioning, we will see rates continue to go up and we will see a pullback in economic growth and potentially contraction. It's not our base case. We do think growth will remain positive. But in the short term, inflation is actually good for the government's budget.
So the one thing about that, and we just saw forecasts from the budget last night about where the unemployment rate will land over the coming years, the real issue is going to be pressure on wages. And if there's pressure on wages, if inflation doesn't come down quickly, that quite clearly is almost self-perpetuating.
Yeah, we think that the Treasury's unemployment forecasts are reasonably accurate. They're very similar to ours, slightly lower than ours next year. But the wages, as you said, the wage outcomes, the RBA has been warning that we see wage outcomes spiral. And on a minor note here, we are seeing wage outcomes in the aged care sector. They will kick in next year at 15% pay rises. So while the government is talking about a minor cost of living package of $20 billion not adding to inflation, there are other things in the budget that could actually stoke a small proportion of the inflation market.
So this is interesting because the budget, having gone into surplus this year, and there's even talk about a surplus next year as well, potentially. There's not too many things that have to go right for that to happen. It also has an impact on the long-term debt that Australia will actually have, and therefore even your sovereign ratings.
Yeah, so debt to GDP has never really been an issue for us with the AAA rating. It is moderately low compared to other sovereigns. What this also does, though, as the government is not borrowing as much as fiscal outcomes improve, on the flip side, inflation is adding to nominal GDP. So GDP itself is rising. So when we all look at the relative size of the debt burden for the sovereign, we look at debt to GDP. Debt is not as high as we thought, and GDP is actually higher than we thought. Nominal GDP is coming in at 10% this year, much higher than most people thought.
And that means the capacity of Australia to be able to afford those rising interest payments, even though people are talking about phenomenal numbers as it rises. The reality is the economy is bigger and has the amount of cash flowing off it to be able to afford those higher interest bills.
That's correct. And we're actually seeing that play out in the market at the moment. We're also seeing that the yield Treasury used last night was actually pulled back from last year because the markets globally are expecting interest rates to start to unwind in the next 12 to 18 months. So there is definitely enough headroom on the sovereign's AAA rating when it comes to the debt side of the budget. On the fiscal side, these numbers, we said they're still in deficit because there's still a $60 billion borrowing happening below the line over the next 5 years. But the fiscal data we saw last night was very promising.
I'll tell you what, good to have you on the program. Anthony Walker from S&P Global, good to have your input today. Many thanks.
Thanks, Ross.